So one thing that people get confused a lot about is they somehow seem to think that to get the stock market to move up, you have to have increased stimulus somehow in one of the various forms people talk about stimulus, like increased government programs or something. And in reality, that isn't really the way it works. The way it works is stocks rise when the future brings positive surprises on an overall basis, and they fall when stocks confront a world that brings negative surprises in an overall basis. And the fact of potential stimulus breaks down into a couple of categories. One of them is it really stimulus or is it really not stimulus? And a lot of things that people call stimulus actually don't stimulate. So therefore, the hope of them could help stocks move forward because they think it's stimulus when it's not, but then when it's not, that certainly isn't going to help any. The flip side is that when you think about the way stocks move, they move more on the hope and less on the reality, because stocks are always forward-looking. As I've said and preached for years, if you've ever heard me talk before, it's one of the most central points people don't get. Stocks are pretty much always pre-pricing the next approximate 3 to 30 months. Whether it's 3 months at a moment in time or 30 months or 17 months, that's really tricky to try to figure out and is treacherous. But they're always pre-pricing the future. So the hope can get priced in before the event. The event can be therefore a disappointment in the vein of sell on the good news. But in this sense, the reality is that no one of these kinds of features, like stimulus, are any bigger or more important than all the other things that are going on in the world. And there are so many potentials for positive and negative surprise all the time as we move forward, that when we think about this notion of stimulus, even if it's real stimulus, is only one of many factors that are entangled together that give us positive or negative surprise moving forward. Now, I'm just going to go back on the prior point for a moment. Said simply, most of the forms of what people talk about as stimulus don't actually stimulate. Let me give you just a couple of examples of that. Often it's thought that when the central banks increase the quantity of money, that's stimulus. And the answer is, maybe it stimulates, maybe it doesn't. Stimulus happens when people overall take more commercial business activity. That's stimulus than they would otherwise if that thing hadn't happened. But the fact of the matter is, for example, in 2020, the United States Central Bank, the Federal Reserve, increased the quantity of money hugely. And the parallel is that the turnover of the quantity of money perfectly offset it. And that when the turnover of money, how often money changes hands in a year, goes down in the same proportion that the quantity of money goes up, there's no stimulus at all. Likewise, there's a general sense often that these programs that put money into your hand will stimulate you, and maybe they will stimulate you. That's real possible. I give you money, you get stimulated. But the money came from somewhere. It wasn't just pulled out of thin air. And because it came from somewhere, usually prior savings from someplace else that otherwise would have been invested in something else isn't spent on. And in that regard, is it stimulus or isn't it stimulus? Net overall, it's really hard to know, and an awful lot of programs aimed at stimulus are actually not only not stimulative, but actually potentially contractionary. So my biggest point is, it's about positive surprise moving forward overall, and this could just be one subset. It isn't the driving feature, whether it's real or not. Subscribe to the Fisher Investment YouTube channel if you like what you've seen. Click the bell to be notified as soon as we publish new videos.